The key support for the RBA's above-trend growth view for 2018 is a stronger, more free-spending consumer. Increasingly, though, it is looking as though the foundation for this view is becoming fragile. This is very evident in the September quarter retail sales release, which we received last week. Having fallen in both July and August, retail sales were flat in the month of September. For the quarter overall, we saw retail sales down 0.3%, which is the weakest outcome we've seen since 2010. We have to make clear that this weakness has not been because of the weather or any other one-off factor. Only food retail has really shown resilience in recent months. In addition, what we're seeing, if we look at across the states, we're seeing weakness across all of the different states, albeit probably more pronounced outside of New South Wales. In the third month of each quarter, we not only receive the nominal sales detail, which we've been talking about so far, but also a breakdown of the retail sales volume for the quarter and also the price change of various goods across the sector in that quarter. Now, this allows us to really assess how much of the decline in nominal sales has been driven by prices, and equally what part is actually due to weaker volumes, or indeed stronger volumes if it was a gain. What we see in this particular instance is that the actual price level has declined by about 0.4% over the quarter. So that actually means that volumes were up 0.1% overall. Now, this outcome for prices is actually the weakest we've seen in 12 years, with non-food prices down about 1.9% for the year. That's obviously a very weak result, and has really been driven by the significant increase in competition we have seen in the sector, and also that this is taking place at a time when the consumer is very cautious and really reluctant to spend on discretionary consumption. So while the decline in the quarter was driven by prices, that we see volumes are only up 0.1% really emphasises that retailers are not really gaining any traction when they are cutting prices. So they're not really seeing people respond and come through and actually go and increase their discretionary consumption. This really highlights the concerns that households currently have around their incomes, and also where their levels of household debt are at and so their overall financial position. And this is despite what we continue to see very strong employment growth in the economy, which should be really stirring a greater willingness to spend. All this sort of paints, I guess, an ongoing picture of concern in the sense that we're unlikely to see the consumer come back and really be much more willing to actually go out and spend, which is really what the RBA needs to see if they are to see their growth targets achieved. In addition to employment, one of the areas that should have really seen households be much more willing to spend is around the increase that we're seeing in household wealth. The last 5 years, we've obviously seen quite dramatic increases in house prices, and equally we've seen equities do quite well as well. And that's meant that household wealth has increased quite significantly. Ordinarily, you would expect, a relatively sanguine consumer to be willing to actually go out and spend some of that accrued wealth. But we haven't really seen that come through at all. And equally now, particularly around housing, we're seeing quite a dramatic slowdown in house price growth. And that really means that we're very unlikely to see this housing wealth come through and support consumption going forward over the next year or two, given it hasn't really come through to date. While we don't anticipate we'll see broad-based price declines across the housing market, it is very much the case we're likely to see very little house price growth going forward, particularly in areas such as Sydney, which has done very well in recent years. And this really will likely continue to see the consumers remain very cautious, both in their expectations around the housing market, but equally how that translates through to their spending as well. So against the RBA's above-trend growth expectation, we instead continue to believe that growth is likely to remain below trend and really dependent on population growth. Given we are also likely to see inflation really struggle to actually get above that lower end of the target band, it is our expectation, therefore, that we will see the RBA remain on hold through 2018 and 2019 as we continue to see the economy really struggling to move forward and get to sort of stronger growth levels. We'll see you next week.